the balance sheet gives you a snapshot, cross-section snapshot of the firm's net worth. So it's a value or a measure or an image, let's say, of the firm's health in the present. Okay? Whereas profit and loss statements refer to the past, a specific period in the past, so trading history could be over a term or a whole year, so it really depends on the period that these statements refer to, okay? And cash flow forecast, like the word says, it basically focuses on the future, so it's the expected income and expenditures of the firm. So you do look for different things in those three different, let's say, documents, okay? One referring to the present, one shows you the how the firm has been going in the past up until now, and the other one helps you to assess the cash flow in the future. Now this is sort of the basic kind of equation. The balance sheet has to balance, as you read in your book. So basically it expresses this kind of concept that all your liabilities, which is the money that you owe to others, if you add this to your equity, it should equal your assets, which is all your short-term and long-term, let's say, assets, which we call current and non-current assets, okay? Plus any stock that you have, short-term and longer-term assets, okay? Now, has anyone heard of this concept of current assets and non-current assets? People that have studied accounting, can you just raise your hand so I can get an idea? So if we look at a balance sheet and the side of it, one side of it that refers, let's say, to the assets, so this column here, okay? When we refer to current assets, we basically mean assets that can be quickly turned into cash. So it's cash and cash equivalent. Okay, and this here gives you a few examples. Now, why would accounts receivable, what would we be referring to with this word? Why is this a current asset? Anyone? Any of the accounting people or anybody else wants to give it a go?
Because people own your money.
Yep. So you expect to be receiving that money very soon. It's as if you basically have it in your pocket for the purpose of this statement, okay? So it's almost as if you have, like you have this cash, 260,000, you also have accounts receivable of 580,000. So for the purpose of this statement, they are considered cash equivalents, okay? Inventory, all these things, you have prepaid expenses, another one. So you see, I've already paid these expenses, therefore, it's almost like cash equivalent. You have prepaid them, you're not going to be paying them in this next, let's say, period. So it's as if this money has already been given. So it's as if you are now expecting part of it back, if that makes sense. Non-current assets are longer term, let's say assets that it's not quickly turned into cash. So any of the equipment that you have, any of the furniture, any of your properties, like physical buildings. And it's in the balance sheet, it's pretty straightforward because they're all listed under usually the title of current or non-current assets. So for the purpose of this unit, you will not actually be asked to classify things under the specific category, okay? So it will be very clearly visible what everything is. So it's up to you to then use that information in the way that we will discuss further on. Okay, liabilities. In a similar sense to current assets and non-current assets, you have current and non-current liabilities. So you might have money that is owed to others that is due to be paid in the short term, okay? Accounts payable, any expenses that you have accrued, your income tax, for example, all these things that are on the slide, okay? And then non-current liabilities, which is money that you owe but will not be paid in this normal operating cycle, okay? What is sort of missing from this? What kind of assets, let's say, is not included in this? So if we go back to the initial statement that I made, that it gives you the financial health of the business. So you look at your assets and liabilities, you can calculate the net, let's say, equity, okay? So say you, based on this, you sell this business today. Would these figures actually give you exactly what you will be making, if that makes sense? So do you actually realize that this is what the business is worth on paper? It's not the real value of the business. Does that make sense? What are the kind of assets, let's say, that are not included in the balance sheet? Yes?
Non-tangible assets, for example, trademarks or patents.
Yep, your brand equity, okay? The intellectual property. So although this is a very useful document, okay, to make you consider the financial health of the business, there's obviously aspects of the business worth that are not included in this, okay, just so you're clear. So this is basically, we can use this information, as we will do later on when we talk about business valuation, to get a basic valuation of the business that does not equate to the actual market value of any business. Okay? Now this is just a graphic display, and I will come back to this when we are talking about the different ratios, okay, which shows you, for example, for this particular case, the comparison of current fixed assets and then the current current and non-current assets, which is just these, and then current and non-current liabilities, okay? Does anyone have any sort of comments just by looking at this? Something that you sort of notice that you think it's, let's say, good or not good for this firm? Any of the accounting people? Something that you pick up, let's say, straight away?
It's an unbalanced firm, I guess, because the current assets made up for a large portion of the asset side of the balance sheet.
That's correct. Which can be a bit of an issue, but what else is, let's say, more of a pending problem? Yes?
Current ratio would be really high because liabilities are 600,000 and assets are
Current assets, so you can actually pay your current liabilities with your current assets. It's not a bad thing. Okay, you think it's a high ratio? Okay, we'll come back to this slide afterwards, and maybe then we can sort of reflect on this a bit with some different sort of into perspective. Okay, profit and loss statement. Now, this slide, which I basically borrowed this from someone, this equation, I just want to make it clear to you that it doesn't sort of make sense from a mathematical point of view. So I'm not trying to say that if you take your sales and you deduct your cost of goods sold, then you get the gross profit. Then it should be a different line underneath that says if you take your gross profit and you take away the overhead costs, you end up with your net profit. Okay? So this should not be one straight line. It does not make sense like that. So make a note in your notes, or if you don't have them printed, just make a note, okay? So basically what this is trying to say, it just gives you the progression of what you see in a profit and loss statement, okay? The order by which these things appear and how you end up having your sales revenue at the top and at the bottom the net profit and the kinds of things in between, okay? But it's not a mathematical equation per se. So what we need to remember from this is that your variable costs, can anyone explain to us what the variable costs are? Give you an example here, direct labor and materials. So costs that depend are varied depending on the amount of sales that you do. So costs that are directly related to the amount of sales that you do, those variable costs, if you deduct them from your sales, then you get a very important figure which we call the gross profit. And as it says here, it's your profit before allocation of any overhead costs, any fixed costs, okay, such as these. Now, when you then take your gross profit, so from your original profit, you have already deducted your variable costs, you get your gross. From the gross, then you deduct all your fixed costs, and you end up with your net profit. And EBIT means earnings before interest and tax, okay? So then if you deduct from this in interest and tax, you end up with your final net income, which is exactly what this slide is all about, okay? So it calculates your gross profit margin, 66.7%, okay? So this is basically 1 million divided by 1,500. And the earning before interest and tax 350,000, and then you can get your net profit margin by dividing this by 1.5 million. Okay? So 2 key ratios here. Fairly straightforward. Now what this slide is trying to say is that what we always need to keep in mind is that there is a cycle, the working capital cycle as we call it. So all these things, or the money that we do see typically in your profit and loss statement, it does not happen simultaneously, okay? It's over a period of time. So money will come to you at a different time than when you actually have to pay, okay, your expenses. So it's, I guess, common sense. It makes sense that you make your purchases, so you incur some costs there, okay? Then you have your production costs, then you have your selling and distribution costs, and eventually you have your sales receipts. Now, it does depend, because in some industries, let's say, you might get the sales money in first before you actually commission the production of the product, let's say, okay? Or part of that money. So this is not to say that in every business it is exactly like that, but generally that there is this lag of time before when you're actually incurring the expense and when you are getting your money from the sale of those particular products, okay? So what does that mean? Why is this important, do you think? Why is this important? To understand that it is profitable. Yeah. So you might have a very good, let's say, business plan or a very good product that eventually, if you do sell this product, you are going to make profit, but you can basically run out of money in this process of production, selling and distribution, if that makes sense. And quite a few small businesses do face challenges that have to do with cash flow. You probably hear it from almost any, business person you hear, small business owner. Cash flow is an issue, especially in a market that is tight, like today's market, in terms of achieving, basically, getting loans and money from banks. Therefore, it's important to understand your business and the ratios and the financial ratios that we will be referring to, the current ratios, which gives you an indication of the health of your business, okay? And making those cash flow projections so you actually know where you're heading to. So the profit and loss statement is not on its own able to show you whether your business is viable or not going forward, especially if you are into a process of growth or rapid growth, okay? Okay, this just gives you some of the measures that will assess you in looking at these issues, and there's a lot of information on this in your book. Now, what I wanted to focus on is these, some of these ratios. So, from the balance sheet, one of the key ratios that we look at is the debt to equity ratio. Okay, do you have enough equity to finance your debt? And as it says here, it should be less than 1. Okay, the current ratio should be greater than 2. Now, there is a little mistake there where it says current ratio, from what I can see. Can anyone pinpoint to that? Yeah, should be divided. Should be current assets divided current liabilities, okay? So, if I just go back to this slide, So if we look at our current assets and current liabilities, like your fellow student said at the back, it is more, your current assets more than the current liabilities, but still, it's nowhere near to 2, okay? And also if we look at debt to equity ratios, there is a major issue there. Okay, so let's do a little bit of calculations. This is very, very straightforward. So can you just write down debt, equity, and just calculate the debt to equity ratio, which we've already done, I think, for this, and then your current ratio. Okay. Anyone ready to offer their opinion? Debt to equity ratio? How much is your debt in this business? Anyone? Sorry? 600 plus? Yeah, which is your mortgages, okay? So it's 700. 600 plus 100,000, 700,000. And then your equity is clearly stated? 300. So your debt to equity ratio is 2.33. Yeah. And then your current assets, it's there, 970. Your current liabilities, 600. So what's your current ratio?
1.616.
Yeah, 1.6. Okay. So like we said, debt to equity should be less than 1. Okay. Suggesting that this firm may have too much debt. Okay. And then current assets, the current liability is 1.62. So as your fellow student said, they can be serviced. However, it should, based on the theoretical numbers that we have, the recommendation, let's say, for a financially healthy business should be greater than 2. Okay. So this does not necessarily mean anything. It may depend on the type of the business yet again, but it's just an indicator that there might be, especially in combination with the problematic debt to equity ratio, you should come up with it will flag that there might be issues here with the financial health of this business, okay? So whereas you will not be asked, let's say, to put a statement like this together, you might be asked to interpret what it means, just like we've done here. It's pretty straightforward. Okay, let's do this one now. This is a profit and loss statement. Okay, so it's got your revenues, it's got operating expenses, okay, which is the cost of goods sold, which we said is your variable costs, and then it's got your gross profit. So what would be your gross profit margin? Anyone? Yes, 2/3, 66.7%. Yep. So you divide 1 million by 1,500,000. It's actually in one of the previous slides, I'm pretty sure. And then What's your net profit margin? I've circled the net income at the bottom. What would that be? You can use, if you don't have a calculator, you can use your phones. It's, sorry, anyone? You divide 350 by 1,500,000 and you get,
23.3.
oops, yeah. Okay. I don't even have it, the 23.3 here, it's one of your previous slides, okay? Now, the issue here is that this does not actually tell you much when it comes to profit and loss statements. What we would normally do, or what they do in accounting, is you have to compare the statements of at least 3 years in a row to be able to see whether the business is heading in the right direction or not, how these ratios are changing, okay? And what they also do quite often in accounting is sort of extrapolate in the future when they're making forecasts, okay, which can be quite risky in a real life scenario situation. So be wary of that, okay? In real life, when you run your own business, you cannot extrapolate with from today's profit and loss statement what will happen in 5 years' time, okay? Now, what's the important thing from a practical perspective? That you actually monitor all your cash flows and these important financial measures, okay? The ones that are more relevant to your business, and to make sure that decision makers understand them, okay? And whether or not they're used for decision making, that sometimes makes the difference from a firm that will trade successfully to one that will encounter suddenly financial problems, okay? And if you do have a very good accountant, they should, even if the owners do not necessarily understand them, if they have a good accountant, so this applies to accounting students in this class, okay? The extended service that you can provide to your clients is exactly that, okay? Instead of just preparing their, accounts or looking after their accounts, you have to also do this function for them, and this is how you can add value to your clients, okay? And that's where the business obviously is heading, or I guess the service is heading, okay? Now I'm just going to run a little video from TerraCycle, which is actually quite entertaining in that it actually shows you how some small businesses that can grow pretty quickly and can be quite successful, how completely out of control they can actually be from the financial perspective, so that all the risks that are lurking there in the background until you actually get someone to become more in control. Let's have a look at this video.
Restaurant environments, and I think the Dunkin' Donuts bring out.
Might can't with anything that we what second measure, what is the process. The difficult is who much to keep it. Because the idea was
The whole cut from mile from I think that was
the CFO.
the pool next year, billion, and relatively speaking, okay, I need to bring some help in.
Hi, the CFO. May I say that? Well, I'm the chief financial officer, but because we're a small company, that means I do pretty much everything that's involved with the money, from cutting the checks to going through the drive-through window at the bank and depositing checks. I run the candy machine because that involves money. I do a lot of reporting for the board and for investors. And we also do a lot of decision support, providing feedback on how a product is selling or what the costs are, whether we should release space or something like that. When Tom hired me, he mentioned that he needed a CFO, and I don't actually think he had any idea what a CFO would even do. One of the first things that I discovered that I had to remedy, and was sort of my first step toward becoming one of the more unpopular people here at TerraCycle, was that 3 employees had debit cards that linked directly to the company's checking account. that they were using for expenses. And no one was abusing them, but there was just no record keeping. I mean, no one really had a sense as to how much money was in the checking account, whether or not the purchase that they were making was going to have any impact on that. When the purchase was made, what it would be coded to. I mean, it was just a free-for-all. Yeah, we had a lot of past due bills, bank reconciliations that hadn't been done. We had no idea how much the product we were making was costing us to make. A lot of the data had been put into the accounting system by a well-meaning intern who had double-entered a lot of it. There were boxes of receipts that had piled up from, travel and whatever. I mean, it was, I found in a drawer a bunch of W-2s that hadn't been sent out because Social Security numbers hadn't matched. I mean, just basically anything that had been a problem for anyone up to that point in time had been thrown into a drawer. And when I found the drawer, that became part of my job. One of the first things that I did was I worked a lot with the head of production to try to get a handle on what we were using in our production process and what we still had in the warehouse, so that we could actually figure out what we were paying to make our product. And one of the reasons that had been very difficult is that everything that had come in up to that date had been charged directly to cost of goods sold. So if you bought, let's say, enough bottles to make, let's say, 100,000 bottles of product, on that day you would charge the whole $100,000 to product, even if you'd only sold one of those bottles. So it was impossible to get a really good measure for what the actual costs associated with our process were. And there was definitely a sense here that because we were making product out of garbage, it wasn't costing us anything. And that was definitely not true. We learn from our mistakes.
I guess I was about the second.
No? Okay. So, very interesting. What does that tell us? What did they actually, what were the very unorthodox things that they did before this CFO was appointed?
Basically, nobody knew who was going to spend what on what for what purpose and all that.
They were just running the business, and because money was coming in and it was more than the money going out, basically they kept going. But there's quite a bit of risk of, going bust in this way. What else were they actually not doing, or she actually implemented, which is extremely important based on the things that we are discussing? Yeah, it's a general statement, obviously, yeah, record keeping. Anything else? Yep. Exactly, yeah. So it's a mix of, liability and control. And, so there was obviously only two or three operators. It was a small business, so they basically, went along. But these things do happen in real life. Okay, this is why I'm showing you this, because I just wanted to register. It's not just what we are saying in this, amphitheater. There are small businesses that run like that, and suddenly an employee walks away and they've, taken a large sum of money with them, or money goes missing, and products go missing, things like that do happen. What's the other issue in terms of financial control that she instigated, which it's very important? I was talking about this towards the end.
So I actually allocated the cost specifically to the point of sale.
Exactly. Okay. And we will talk about breaking in the next, let's say, this topic that we will touch on. But it's very important not to only know what your costs are, but how that relates to production. Okay? How much is variable, how much is fixed, and if you have a number of different lines of products, which is what she was potentially trying to do, also to assess which products are more viable than others. So managerial accounting, it's it's not just record keeping for the purpose of the tax office. It can really assist you to understand what part of your business is profitable and which part is not. And you may actually find walking into a business that there's a lot of things that they do which is actually not profitable or not contributing to their bottom line, and they just do it, or even services, they might be offering a number of services, and some of them they're losing money. Is that acceptable, you think? Anyone? Let's say you are a small business owner, you have a product and some services on top of that, in terms of customer service, blah, blah, blah. In some areas you're making money, in some other areas making less, or you're actually not making any money at all. What do you think? Take a while.
Some of the non-profitable initiatives might be awful though.
Exactly.
You can't get rid of it.
Exactly.
That can generate real profit making.
Yep. So not everything is profitable, and that's not the essence of this. Okay, you can't minimize costs or make sure that every activity is a profit-making activity, but you have to be aware of these costs. Okay, and these need to be conscious decisions that you make, rather than just be faced of costs within the different parts of the business without realizing why and how that all fits into the picture. Okay. Now, I just wanted to make a quick correction of what I said earlier. So I was just looking at the slide initially, very quickly. In terms of prepaid expenses, why are prepaid expenses part of current assets? Any of the accounting people able to answer this? I think I inadvertently say because you are expecting this money to come in. It's not money, it's usually prepaid expenses, so in relation to, let's say, a product. So you are expecting this product to come in, so it's as if you have a product there, but there's not necessarily physically there, but that's why you consider this as part of current assets. Now just moving forward, we cover all this. Gross profit margin. This is an example. Very similar to what we did before, so we actually have calculated that already, okay? But it just gives you the variable costs. So direct material cost is obviously a variable cost that relates directly to your sales. Labor cost can be variable. It depends on whether it's allocated to that particular function or whether it's an overhead salary, admin, let's say, okay? But you might have labor cost that's directly related to that particular function. Example? Any examples? Is that clear, or would you like for example, when your teachers come in or when I come in here, their cost, because they're paid by the hour, is directly related to them providing the service. Okay? Admin cost with this university is an overhead cost. Okay? So we have the total, let's say, variable cost in this particular instance is $65. Therefore, the gross profit is 35. 100 minus 65. Okay? And then your gross margin is this percentage, 35%. So what does that mean? It means for every dollar that you get coming in through the door, 35% of that is what is left after you have paid for the variable costs. You haven't taken into consideration the fixed costs as yet. Okay? Now what I wanted you to calculate is this. Okay? Say that we have these different cases of income coming in and these gross margins. So each one is a different case. What would be your, sometimes they call it gross margin in dollars, it's actually gross profit, okay? What would be your gross profit here if this was your gross margin? I will give you a couple of minutes. Go through the exercise, don't just look at it. completely different? No? Okay. Huh? Okay, so in all cases, just a very simple, I guess, way to illustrate to you that irrespective of how much turnover this business has, the gross margin will be dependent on, obviously, your gross margin as a percentage. So when you talk to people and they say, oh, I run a small business and it has yada, yada, yada turnover a year and what have you, that actually means absolutely nothing. Okay? So what you need to be focusing on is what is your gross margin, and then you want to increase your sales, provided that your gross margin will stay the same and will not start decreasing as a result of you increasing your sales. Okay? So, I just wanted to show you this little diagram. And let's put our critical thinking hats on. It's tiring and it's a difficult time of the day. Anyone that's able to explain to me what this means? So I'll just circle a number here. There we go. What does this stand for? What they've taught us in engineering at least is every diagram has to be self-standing. So it should not need any explanation from you.
I would say that you have an existing gross margin of 25%, and then if you reduce your price by 10%, you need an extra 76% volume increase in order to maintain
Yeah,
25%.
67.
67.
Yeah, exactly. Okay? So this little diagram shows you the power of the gross margin. Okay? Depending on the gross margin of your business, a 2%, let's say, price reduction might need you to sell anywhere from, okay, this is an extreme example, but let's say from 10 to 15% more volume to actually achieve the same gross profit, which is an interesting thing to consider. You know, when it comes to sales, when it comes to all these offers that we are constantly bombarded with, and when large businesses generally have these sales on, as a small business operator, when you try and match these, okay, or when you're actually making discounts and offers without actually realizing this, then you can run into a lot of financial trouble. Does that make sense? So why do you need to know your gross profit margin? Because then you can make financial decisions such as this in relation to pricing your products, in relation to your offers, your sales, what kind of discount do you offer to your loyal customers? Okay, depending how loyal are they and how much more business are they going to do with you? How much more are you expecting that you will increase your volume if you offer this price discount? Does that make sense? So you will have to be expecting an increase much more than this to offer the 10% discount if you only have a 25% gross margin. Is that clear for everybody? So a higher gross margin, obviously, so in this example here, we have gross margin is 50, allows more flexibility in your pricing strategies, okay? So if I ask you why in the exam, you will know how to answer this question. Okay. We've spoken about gross profit. Let's talk about break-even sales. What do you think break-even means? Break-even can mean different things to different parts of your business, okay? Or let's say not parts of your business, maybe at different stages of your business, okay? But when we talk about break-even sales, what would that mean? It's so straightforward that no one gets the answer.
Revenue sales is the same as the cost.
Yeah, so basically, how much money do you need how much product do you need to sell, how much revenue do you need to acquire to equal your cost of production, and say from that moment onwards, you start making money. So you have actually covered your fixed costs, okay? Not just the variable cost, but you've covered your fixed costs. you are making money based on the gross margin, okay? Because the variable costs are always going to be there, but you've covered your fixed costs, and from that point onward, that example of 35% gross profit margin means every additional dollar you're making, 35% of that is profit, okay? In another situation, break even, if we, let's say we're talking about investment, because we did like a little example with an investment sort of earlier, last week, or when you setting up a business, when you talk about the point where your investment breaks even, you actually obviously mean a different thing, correct? What would that mean? Say you're setting up a business and then ask you what is your break-even point? What do they mean by that? Yes, that's right. When you recoup your investment and your gradual operation cost, but when are you actually line zero when you have recouped that investment? Okay, so it's a same word, different concept. Okay. Now this is the formula that you see in your book and gives you the break-even point. Now I dislike formulas unless I completely can understand what the formula means. Okay. So I'm just going to give you a little example here of how I always think of this, even if you don't know the formula. Or sometimes you can get quite confused by this percentage here. You go, well, does the 100 go? Does it go here? Does it go there? So a different way to do it, okay? Based on this formula, what is the break-even here? Does anyone know? Anyone? The other way to do it is this. What does this mean, gross margin? That for every $100 of sales, you make $30 gross profit, correct? The break-even is how many dollars of sales do you need to actually cover those $3,000 of fixed costs, okay? So if you apply the rule of 3, and I hope that everybody is familiar with the rule of 3, you go 3,000 times 100 divided by 30 to get this one, okay? So like your fellow students said, 10,000. Feel free to apply the formula. If this makes more sense for you, feel free to apply this, okay? I want the right answer. Okay. Say your break even, so we calculated, is $10,000, okay? You only make sales of 7,000. How much is your profit or loss? It's not much longer, it's only a couple of slides. So just focus and try to give the answer, because if you can give the answer now, you will be able to give the final exam very easily. If something like that happens. Who said that? You're close, but not quite. That's part of the answer, obviously, the $3,000. Anybody else?
6,000.
Okay, let's give it a go. Now, your sales of 7,000, you have a break-even of 10,000, okay? So, with your sales of 7, there's two ways to calculate it. One way is to say 30% of the 7,000 is 2,100. This is my gross margin. The 10,000 and 30%, this is my fixed costs. So I actually have not covered 900 out of my fixed costs. Does that make sense? Okay. The other way to do it is, okay, I have a shortfall of $3,000 to reach break even. So 3,000 is not actually your loss, okay? Multiply that by the gross margin and this gives you your loss. Make a note of this because I'm going to ask you one more thing, okay? So this is how you calculate it. This is, by the way, these solutions are not going to be on the PowerPoint online. So I guess an answer to what your fellow students said over there, why is your shortfall not the $3,000? Because if you have sales of 7,000, okay, yes, you need 3,000 to reach the break-even point, okay, but within that break-even point, there is some variable cost that you have not incurred with the $7,000 sales, okay? Okay. Accountants generally go like this, the rest don't really make much of a rule, I would think. But any confusion to this, please feel to email me after you have the time to digest and think about it, okay? Now, exactly the same example, I think. Yep, the givens are the same. Say you have sales of $15,000. This is now easier, okay? How much profit or loss are you going to have?
Would be 1,500 profit.
Very good.
15 times 30%.
Did anybody else get the same figure? So it's very similar to what we did before, or you can easily go, the excess over the break-even point is $5,000, okay? So if I take away my variable costs, so if I multiply by 30%, this is my net profit, because I've taken away my variable costs from that 5,000. Okay? So basically what this is saying is that you make $1,500 profit on sales of $5,000 over the break-even. Let me take the notes. Come again? Break even? So the break even, yes? Yes, the excess over the break even. Less your gross margin. That's the same thing. Yep. Your fixed costs have already been taken care of by the break-even point, I guess, when you calculate it this way. Yes, oh, there's different, of course there's different ways to think about it and calculate exactly the same thing. Yeah, and this is not the only way to do it, to apply the formulas. You can apply them in any order or sequence that you want. Yeah. As long as you end up with the same number, so obviously when you're rehearsing this, you can do it in a different way than this. As long as you end up with the same number, and when you do it makes sense, it's fine. Okay, ways to reduce your break-even. Obviously by cutting your fixed costs, okay, or by improving your gross profit margin. And I'm not going to get you to do this, but this is just another example that says if you increase your profit margin, what happens with your fixed costs, blah, blah, blah. So this is all in the slide, I'm pretty sure, or if it's not, it's exactly the same as the previous example. Okay, so this is just the last slide that I have with some calculations, and they're much easier than what we've done this far. So I'm just going to go ahead with this without making you do more work. What does this show us? We have an annual forecast of the different income and expenses. Okay? So if you are given, say, this, it's fairly straightforward to then calculate these projected profits. So what it says here, sales is the same as this. The goods or materials used, which is your variable costs, okay, will be 2 plus 3 minus 4. Wages or salaries is already given. variable cost, sorry, there's a variable cost, so this is just goods or materials so used. Variable cost, you need to add this plus the wages or salaries, and then you get your profit before fixed costs. Okay? So this can be given, or you can calculate based on some very simple calculations like this one. Okay? Gross profit margin is the gross profit of 56,000 over your sales, 25.9. So we've done this a number of times today. Fairly straightforward. If your gross profit is reached and your fixed costs don't change, then your break-even is calculated like this, which is again the same formula that we used. Break-even in this case turned out to be 80,000. How can we check our calculations when we do this very simple exercise, yet quite a few people, don't get it right? You can always check if you've got the break-even correctly. Do not forget this. You just go, this is my turnover, what I thought is my break-even. Let me multiply it with my profit margin and see if I get enough to cover fixed costs. There's obviously an extra zero here, okay? So it's 20,720. So basically what I'm saying here is, if I ask you for the break-even, make sure you check yourself whether you've done it correctly. Just multiply with the profit margin and see if you get the fixed costs. Does that make sense? Okay. And obviously when you do that in a real life setting, you can also look at break-even per month or per quarter. Is there somebody raising their hand there at the back trying to ask a question? No? Okay. Now, one key question. What is the key assumption that we have made here? Yep. So we basically made the assumption, what is constant? That your fixed costs do not change. Okay? Therefore, your break-even is constant. Okay? However, in real life, you can have different scenarios. Okay? So in this one, as your sales increase, so your volume of sales increases, your break-even actually reduces. How do we call this? Economies of scale, exactly. Okay? It's not always the case. This is what you hope for, generally speaking. In some cases, you do actually get the opposite. As your sales increase, your break-even also increases. You end up working more for less. Okay? That's why they call this manager easy based on that. I guess paper. And there's other scenarios. Okay, so the important thing to remember is that break-even, we don't just calculate it once and that's it. You have to monitor how this evolves as your business grows and as time goes by. Okay? So, principles of financial control. Measure your break-even regularly. Focus on getting the break-even down relative to sales and keep it obviously below sales. Reduce your break-even relative to sales by improving your gross margin or reducing your fixed costs. This is not always possible without reducing, let's say, the quality of service, or, I guess it also depends on the environment, on the environmental parameters, how much salaries are in today's day and age and how they increase incrementally. So you can not always reduce your fixed costs. In some cases, your fixed costs will keep going up and up. Okay? But how can we improve your gross margin? Any ideas? This is my last question and my last slide. How can you improve your gross margin? Anyone? Yes? 1 point, you can raise your price. How else can we do it? Come again? Reduce your variable cost. Thank you very much. These two I was expecting you to come just like that. And the third one is if you actually achieve a better mix of sales with higher contribution per product, depending on which products are the ones that have higher gross margins. Okay? If that makes sense. So if these products contribute more to my gross profit margin and this one less, let me focus on the ones that are more profitable. And avoid trying to increase sales by reducing prices. Okay? Because this usually leads to the previous example that we said, the busy pool. Not a very good strategy, especially for a small business. Thank you very much. Next week we have a guest presenter, and the following week after that we get again. So we have a business consultant that's coming next week. She's very, very interesting. I urge you to come. And the week after that we have Adrian Schmidt sitting on the board of the business school. He's a very, very interesting person.